Hi everyone, I'm Paul and welcome to my market update for the 14th of September 2022. Over my last few updates, I've talked a lot about the Fed and the extraordinary measures they're taking to try and temper inflation. However, the market's been banking on a Fed pivot and a cooling of inflation, and it's pretty much looking for any reason to keep going up. Fed Chairman Jerome Powell took a somewhat unconventional approach using his Jackson Hole speech to send a very clear message to markets that the Fed would use all of the tools in its arsenal to fight inflation, and that the expectation should be that rates will be higher for longer, and that they, the Fed, had learned from their past lessons in terms of reversing rate decisions too quickly. This message, however, seemed to fall on deaf ears as risk markets across the board had some of their biggest day gains just a few days ago. All of those outsized gains, however, disappeared just as quickly on the back of the most recent CPI print. As I've warned in some of my previous updates, it was only really going to take one bad CPI print for the markets to start to recalibrate. So what were the CPI numbers that triggered this recalibration, and what's the implications of that? I'll answer those questions and review some of our regular charts, the Dixie, Bitcoin, Ethereum and the S&P later on in the video. But for now, please make sure you like this video, and if you're enjoying this content, make sure you subscribe to my channel and turn on notifications so you don't miss any future videos. Now let's jump into today's market update. So to set the scene and get some context for the rest of the video, let's run through the actual CPI numbers that were reported. So for August, the year-on-year increase was 8.3%, which was an increase of 0.1% over the prior month. Now, the reason why that's important is the expectation was that the increase would only be 8.1% year on year, and that there would actually be a decrease of 0.1% over the prior month. Now, the other figure that's getting a lot of attention is the US core CPI data. Now, the core CPI data removes food and energy, and the reason why these are removed is because they can fluctuate quite a lot. So for August, there was a 6.3% year-on-year increase and a 0.6% increase over the prior month. And again, why this was significant is the expectation was that it would only be a 6.1% increase in core inflation and a 0.3% increase over the prior month. So as you can see, over both metrics, not only is the inflation rate still quite high, but it's actually increasing month over month, and it's actually higher than expectations. So this data just confirms what I've been talking about in previous updates, is that one of the fears, and I guess one of the major concerns is that inflation is going to be more persistent and stickier than it has been in the past, and that's going to lead to the Fed taking more significant action and potentially having to have rates at a much higher level for an extended period of time. We just really need to go back to what Jerome Powell said at the Jackson Hole speech just a few weeks ago, and these are just a few quotes that I lifted from his speech. It was a very short speech, but was designed to be, very concise and a very clear message to markets. He said that there would be a restrictive stance for some time. The historical record cautioned strongly against prematurely loosening policy. So this is saying two things, is that one, that rates will be higher and that restrictive stance will be in place for some time. So that, harks back to what we were just talking about with those inflation numbers and inflation being more persistent and stickier than expected. And the second part of his statement, where he talks about prematurely loosening policy, this is specifically referring to, what the market expected the Fed would do, which is to pivot. So in my mind, Jerome Powell saying very clearly here is that rates will need to stay higher, they'll need to stay higher for longer, and that they've learned from past lessons in terms of loosening policy too quickly. So for my mind, that takes a Fed pivot just completely off the table. He then goes on to say another unusually large increase could be appropriate. Now, I've already seen some very large increases, a sort of standard increase, if you like, would be 25 basis points. And we've seen much larger rate hikes than that in some of the previous Fed meetings. And then Jerome Powell finishes by talking about bringing supply and demand into better balance. And again, I've talked about this in previous videos as well. I think this is very clearly talking about demand destruction. So based on that CPI data and the posturing that we've received from the Fed, again, very clearly from Jerome Powell at that Jackson Hole speech, what are the implications? And so, as I've mentioned a few times in this video already, rates are going to be higher for longer, and the market just needs to, finally accept that. I think a 50 basis point increase by the Fed at the next meeting is pretty much off the table. If you recall back to that last slide, Jerome Powell talks about it being appropriate to potentially have larger hikes in the future. And so as a consequence, I think a 75 basis point increase is almost baked in at this stage, and the potential for a 100 basis point increase, which only a few weeks ago would have seemed almost impossible, is now starting to look like a possibility. As we project into the future, it's looking quite likely that we could have a 75 basis point increase in November, and even potentially another 100 basis point increase in December has also increased its odds as well. Now, what we saw on the back of this CPI print is that risk markets across the board lost nearly all of the gains that they made in the short squeeze that we had just a few days ago. And my view, certainly over the last few months, is a hard landing is now looking very likely, and that there's a chance that the Fed may overshoot with their interest rate hikes and actually create a deflationary environment. Now that's extrapolating into the future a little bit, and it might seem almost impossible given the issues that we have with inflation right now. But this is certainly in the realms of possibilities, just given this unprecedented action that the Fed's having to take to try and fight inflation. So now that we've covered off on the CPI data and what the implications of that are likely to be, let's jump in and have a look at our charts. And so we'll start with the DXY, or the US dollar currency index. And as you'll know from my previous updates, this is one of the charts that I look at all the time because I think it gives us a lot of information about whether we're in a risk on or a risk off environment. As you can see, the bull run on the DXY has been super strong. We've obviously had a little bit of a pullback, but it just continues, and I just don't see this run finishing anytime soon. So you can see we've already attacked this buy side liquidity here. We've taken this out, looking at the monthly chart, by the way, and where I think the next draw on liquidity is going to be is into this fair value gap up here. And the way I've chosen that is, if we look at this displacement that we have here on the monthly chart, you can see these consecutive down close candles, and we have these imbalances which have formed on the way down. You can see as we broke market structure here, these are our down close candles. If I run my fib from the entirety of the move that broke market structure, so from here to here, if we go to the 50% level, that takes us to this imbalance here, and we draw that across. And so that's the target that I'm looking for, and you can see that coincides with this swing low, which was where the break in market structure was. I think we'll sort of trade up into that zone before we consolidate, and then potentially start to, pull back into the new year. Now what I've done is now drilled into a 2-week chart, and you can see the strength of this run, and you can see all of these down close candles have just acted like little speed bumps. Every pullback's been bought, and you can see as we had this pullback here just really recently, and you can see we had a bullish fair value gap which formed just here. So you can see we broke market structure here. We've got our 3 candle formation, and the market's pulled back into that zone before trading higher. And so all of these factors just build up confluence that I think we'll still continue to see a upward march on the DXY, and I think we'll trade up into this zone. Once we get there, we'll examine the price action and just start to make some determinations from there. And just as a quick bonus, we'll have a look at the euro, or the EURUSD. Now remember, the euro makes up the vast majority of the DXY, and so any moves in the DXY are going to be replicated here or reflected here. So you can see how strong this down move has been on the euro. We're under parity now. You can see now the draw on liquidity is most likely to be this sell side liquidity relative equal lows down here. And so again, that just builds confluence for where we think the DXY is going to go in the near term. So moving across to crypto now, and we'll start with Bitcoin. One of the things that really stands out on the Bitcoin chart is this all-time high here from the previous cycle has really acted like a support line for the market. You can see every time we've traded below that line, we've just deviated, come back on top. You can see that's happened a number of times, and it even happened again down here. And this is that big short squeeze that I was talking about earlier in the video. So you can see Bitcoin's just played this out almost perfectly. You can see we traded down, we took out this sell side liquidity, we've consolidated along that all-time high level, we deviated underneath it, taking out this sell side liquidity before we rallied higher. We came up into this bearish fair value gap that we had up here. We took out this buy side liquidity relative equal highs here. You can see almost, to the letter, we came right up to where this break in market structure was. We just touched that, and you can see, coinciding obviously with the bad CPI print, the market's just sold off really aggressively. It's almost touched down to that all-time high level again. So again, that level's been acting as, support. We're just painting a small up close candle at the moment, and we look set to create another bearish fair value gap, just depending on where the market closes on that next session. And so my immediate expectations is that if we do get a bearish fair value gap form in this area here, that we will likely, consolidate at this level, trade up into it, and then we'll start to seek out this sell side liquidity at this low here. And then eventually, I think we'll attack this sell side liquidity at this swing low, the current cycle low, before we probably march lower. Now, switching across now to Ethereum, and obviously with Ethereum, we have this background narrative of the merge happening. And, regardless of what you think about the merge, Ethereum has been much stronger than Bitcoin. You can see the strength of this run here. And now as we run into that CPI data, it's obviously had, the same fate as Bitcoin. We've had a big down day, but equally the merge is still approaching. So it's going to be interesting to see what the market does in reaction to that. You can see after taking out this buy side liquidity relative equal highs, the market's traded down. We've taken out the sell side liquidity on the way down. Before the market's reversed, we've taken out the buy side liquidity here, traded right up into this fair value gap on the daily just here. We've pretty much completely closed in that imbalance. And then we've obviously had that bad CPI print, and the market has immediately traded lower. Similar to Bitcoin, we're starting to paint another bearish fair value gap here. Again, we'll just have to see how the market closes. But similar to Bitcoin, my expectation is that we'll potentially consolidate into this level before trading into that fair value gap before we start attacking the sell side liquidity here, and then these relative equal lows here, potentially before attacking this sell side liquidity down here. The difference between Ethereum and Bitcoin is because that rally in Ethereum was so much stronger, that cycle low, the swing low that we have down here, is much further away. But we may see, a little bit of catch up, if you like, and we've certainly seen Bitcoin outperform Ethereum more recently, is we may see Ethereum pull back much more if we start to see a broader correction across risk assets. And so finally, we'll swing back to our traditional markets and just finish by looking at the S&P. So similar to what we saw on Ethereum, the S&P rallied higher and took out this buy side liquidity relative equal highs here before trading lower. And you can see we painted these bearish fair value gaps on the way down as we took out this sell side liquidity. The market reversed, and you can see it was a really strong rally. We had these gaps that formed here on the way up. You can see we've traded right up into that bearish fair value gap, and then we had the bad CPI print, and you can just see how powerful this candle was. We wicked right into this higher bearish fair value gap before just crashing right through the second fair value gap, filling in all of the imbalances and these gaps here on the way back down. And we're again starting to paint another bearish fair value gap here, and we've just got a little bit of a spinning top candle forming here, so we'll have to wait and see what happens. But you can see we have a very similar setup that's occurring across all of these risk assets, where we have another bearish fair value gap starting to form. So you'd expect we'll have a little bit of consolidation. We're obviously leading into this upcoming Fed meeting. We could potentially trade back up into those fair value gaps, and then depending what happens, we'll attack, I think, the sell side liquidity that's residing below those fair value gaps. And I think we're going to start to see lower prices across all risk assets, which is in confluence with what our view of what's going to happen on the Dixie or the dollar index. I hope you enjoyed today's market update and that you got something out of it. If you did, it would be great if you could like this video, because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you next time.